All right, welcome back to the black hole of real estate. And today, let's talk condos. The sales reports are out, so I'm going to update you on the number of condos sold as well as median sales prices. We're going to talk about Airbnb properties and also the insurance and what's going on right now on a weekly basis that's altering the way the condo market is going to work ongoing. So, first up, the sales. July 2023, numbers are out. 119 sales in the local Daytona Beach area. Median sales price 310. The month before in June, 128 with a median sales price of 309. So a few less sales. Median sales price actually ticked up $1,000. So prices have held firm, which we've been talking about. The bottom of the market, as we called it, was November 1st of 2022. And since that time, prices have not dropped. The bottom didn't fall out. It wasn't 2008. It was never going to be, and that hasn't played out. Now, what has changed is the number of condos being sold. And we can look at last year in June and July, reporting 154 in June, 127 in July. And what we notice right now is the 127, 128 number, that's consistent over the year. We did spike in June of last year, 150, but if you look at 119, 128, 127, it's in a pretty tight range. So maybe we had a few extra last year, but largely the units haven't changed too much. Median sales price has held firm. That's something you should hang your hand on a little bit right now. Year-to-date sales, this is where you see the number changing a little bit. So the sales year-to-date, 23, 801. The year before, 1160. I mean, that's 360 less sales. And the median sales price for the whole year, including condos and condotels, vacation condos, everything, $299 last year, $287 this year. So a little softening of price. But a lot of those lower prices were in the vacation properties, the condotels and the smaller ones. And I think some of that inventory let off. There's been a couple of condos that have been fire sailing, dramatically below. Due to special assessments, people are bailing on some of these condos. When you're getting massive special assessments, and there's a building locally called the Plaza, they got hit with a $23,000 assessment per unit and was decimated. So they've got to rebuild it. So after you pay for the assessment and you have an ongoing fee of like almost $1,000 a month for HOA fee, so over 2 years, that's another 24 grand. You're almost at 50,000. And by the way, you got to pay to redo your whole interior because the place was gutted. 37 to 43,000 is the two price points that you could renovate at. One a little bit nicer than the other, right? And all of a sudden, you're looking at nearly 100 grand for some condos that people might have paid, 50 to 100 for. So it's been significant. So you're seeing some fire sailing of condos, which is really representing some of the softening in the market. It's going to go on for a while this way. So the year-to-date sales are off, the median off just a little bit, but I'm going to put some asterisks on that. The fact that we're selling this many condos in a market where buildings were shut down that had tremendous hurricane damage last year, gigantic special assessments, and a really long, protracted rebuilding and renovating these buildings. There's luxury buildings. The Bella Vista, for instance, they had a big assessment, and they just had another one to complete the project and refresh the reserves as well. That one's actually coming back online. I'm going to say fully ready to go. Probably end of September is what they're telling us right now. They're the final phases of that renovation. So the market is strong despite some of the special assessments that have taken place. The prices have held firm. We'll see where this goes. It gets really interesting though. We're touching on special assessments right now, which is going to probably take us into the insurance piece in a little bit. But before I jump there, there's been a hit to the vacation property market. And I can't tell you that it's just one thing that's conspired to change the vacation property market. I think there was a surge last year, people going on vacations. I do. They've been cooped up during COVID. They got out and they went on vacations last year. And they really ran it up. And a ton of properties came out, Airbnb type of short-term rentals, and it was all the rage. And what's changed this year is things like gas and travel and accommodations and food, and everything's gone up so much that now we're finding that people are going on less vacations, or the hotels. They've been super competitive in offering rates and perks and packages that have put some pressure on the short-term rental industry as far as the Airbnb type. I mean, a hotel, I guess, is also, it is short-term rental, but a lot of people are going back. I mean, there's big bucks in the hotels. They were going to fight back, and they did. So the Airbnb property business has changed. Less people are doing it. The prices have certainly softened in some of the Airbnbs, and that's making a difference. And I know that if you go to get a hotel in a major city right now, it seems just like it's going through the roof. There's pressures in both directions. It's kind of an odd market to be looking at right now. But in major cities where they're having conferences and destination vacations and events, trying to get a room gets a little bit pricey. So I think you'll see some ebb and flows in this vacation rental property market. That's definitely one to watch. That one probably is the most variance right now because some people are cashing out of those properties to do other things with the money. You see, there's this pressure on price because some people are simply having to sell. Maybe their businesses are off due to inflation or the cost of money. I mean, good God, a lot of commercial developers I know, they're really being squeezed on the way that they can finance their projects. So we'll see how this plays out over time, but the Airbnb, there might be some opportunity towards the end of the year for someone who wants to buy in at a price that's a little bit different when you look at the revenue scape in front of us. So I think that's something to really watch for. So the insurance thing is the other kicker. It's gone up dramatically. And so if you're in a condo association, let's say 100 units in there, and the insurance went up dramatically, like double or triple, at some point the monthly association fee becomes so big that it's painful to the owners in the building. And there's not a cheaper option out there, so now you've got two choices. You can absolutely raise the insurance cost portion of the HOA fee to where it's exorbitant for a unit owner. Or you can lower the coverage of the insurance, which is dangerous to the owner, but it's a temporary fix for the pocketbook, and the hope is that nothing bad is going to happen because there are some buildings that are absolutely underinsured right now as far as replacement costs, and I guess it's a form of self-insurance. They're willing to take on some more risk in order to have some insurance, but not price some owners out of the building. And here's where it gets scary. If there is a catastrophic hurricane damage and they are self-insuring or underinsured, you can choose your way you want to phrase that to yourself. It simply means that there may not be enough money to rebuild the building. It also means that financing, as we know in that building, is likely to go away because if you don't have the proper insurance on there, a lot of lenders are just going to run away and not want to lend in that building. And when that happens, it means your pool of buyers are cash only, which if it's 100, 200 grand, it's one thing. But if you're talking luxury 800 to a million, and all of a sudden it's only for cash buyers, that's certainly going to limit the audience. And at $1 million, do you want to be in a place where the insurance is less than you might have enjoyed in a different building or might have gotten just last year? Conundrum is the word that comes to mind right now because if we raise the HOA fees to cover the insurance, it puts pressure on the owners. And if we don't have it, then it puts pressures on the owners that want to sell because it's a different product. And the market's not sure how to treat this just yet, but I know the banks have already voted and said that we're not going to lend in buildings like that. So if you're a board member and you're making these votes, and I'm sure that it's difficult, but if you underinsure or self-insure a portion of this, congratulations, you've been a cash-only building for one day now, and we'll see how it plays out. And my suspicion is someone's going to sell, and it might be for less of a price than they might have gotten if it was fully insured. And as you reset the deck on sales comparables and recent sales, I think it's going to affect pricing for the other unit owners, and that could be a bit of a downward slide. So luxury condos is something we're really watching right now to see what happens to availability, also with price. So where does the condo market go from here? I think overall is very few buildings that have made the option choice to self-insure and go to being a cash building. And we do see that the prices have largely held firm over the last few months and very comparable within a percent or two of last year. So the pricing's still been firm. The inventory, that's the only thing we really haven't talked about. And it's up almost 50% more than last year. Right now, we had over 950 condos available during the month of July, and it's within a couple from June. That's up quite a bit from last year, 50.9%. So inventory is out there. People are taking a little bit longer to purchase, but now that the inventory is rising, there's more selection. So overall, I think that's pretty good. Where do we go from here in the condo market? If you are looking for an opportunity in Airbnb, I'd be watching over the next few months for that. I'd be really careful to look at the insurance that's available on the building and read the coverage or ask an expert what that means for you. I'd be looking at reserves. Does the building have proper reserves? And is it segregated down to a sinking fund for a roof, balconies, common areas, elevators? Are they saving for each one of those things that are likely just, I mean, if you have an AC in Florida, what, 10, 12 years? Well, balconies might be good for 20 or so years, right? Maybe longer, depending on how they do it. But you're going to have a new roof on there at some point, maybe 20, 30 years. Are they saving enough money today to be able to pay for the roof down the road? So I would really look at the reserves and the budgets and how they're treating this. And the amenities as well. Are they coming for a hit as well? You know, pools, the cost of pools and reconstruction of those have gone up dramatically as well. Seawalls is another thing to look at. So this is something that if you go at your own, just do your homework. If you have a licensed professional that's helping you, make sure they excel in the area of condo sales. So that way you're getting the information you need to help you today as well as down the road, so you can pre-plan for those repairs, just like at your house. Special assessment isn't a dirty word for condos. It's just doing the maintenance, either saving for it or paying it when the bill comes in. Same thing that you do at home, nothing different there. All right, I hope you guys were able to get some really good condo information today. I'd love to get some comments on this so I know what to address next when it comes to the condo market along the ocean and vacation areas. Until then, I'll see you next week for another episode of the Black Hole of Real Estate.